Hey guys, it's Stock Karen here, and I want to speak with your manager. I have a complaint. I'm a pear shape driving a minivan, texting on a cell phone with a bob haircut and no makeup on, and two rotten kids, and
Oh, guys, I'm sorry. I was just having a conversation with my business partner. This is DannyDealz. Thank you for tuning in to Un Poco Mas. Stock Karen is going on her break right now, but I would like to talk with you about the SOFI stock, ticker symbol SOFI. Let's just get right into it. I made a video yesterday about the downgrade and the two analysts, one who put a buy rating on the stock at an $8 target and one who had downgraded from the $8 mark to $5. That was Wedbush's David Chiaverini. That was his reaction to the earnings report. Um, you'll note right here, he was at $8. Um, these are his buy. He put, six buy ratings on the stock in a row. Then the earnings report came out. He changed to a neutral and set a $5 price target. So he had all the data at that point. And then there was a massive short attack that just happened to coincidentally coincide exactly with his massive downgrade from 8 to 5. And then just again coincidentally, as shorts need to cover their short and drive more retail out of the stock and beat SoFi down even more. Wedbush analyst David Chiaverini, who is a 0 star analyst, if you see there's 5 stars, he has about a tenth of 1 star, 0.25 out of 1 star. He is the worst back tested analyst, one of the worst you could be. He's number 7,942 out of 8,366 analysts that is tracked by TipRanks. So his performance is abysmal and his reputation is absolute dog crap. And he just cut his rating again after the earnings report, his second cut from a hold to a sell, and he cut his price target again from $5 down to $2.50. So after the earnings report, two downgrades from Mr. Chiaverini, and he cut his price target from $8 to $2.50 on the back of the earnings report we saw about 2 weeks ago. Which was by no means terrible or catastrophic. When you take a look at cuts like this, you're expecting to see absolute doom and gloom, massive declines in revenue, profitability, increasing losses. With a company like SoFi, you'd expect to see management off the rails, growth, negative growth. You expect to see some danger of bankruptcy, some indication of a big capital raise they're talking about. All of this stuff that Wedbush analyst David Chiaverini cites is like sort of well-known data points. In one instance, that what he used to indicate that they're planning a dilutive capital raise is like boilerplate legalese language from the ER that said um, that if they can't reach profitability and they continue to make losses for the foreseeable future, they would have to raise more capital to continue operations. It's like this is just like literally like boilerplate legalese that's in every single ER. Like, yeah, of course, if they can't reach profitability as expected, that'll be an issue, But that's like a warning from the ER. It's just stuck in there to for legal reasons. It's the company's not saying they're not going to achieve profitability in the fourth quarter. In fact, they've just this Noto and Lapointe, everyone's been out saying they expect to achieve gap profitability in the fourth quarter, and these are audited financial statements. These earnings reports, these are not like some kind of like just speculative made up numbers. So if they're going to achieve gap, and the company already makes money on on a cash flow basis. So I think the concerns, the other main concern is just their accounting method. Basically, they hold their loans for some time, but they are marked for sale, so they don't have to hold the potential losses from their loans in reserve. And they're basically saying, like, look, if SoFi did their accounting the way Lending Club does their accounting, their book value would fall by 60%. But then they go on to say, I mean, there's no real indication SoFi is going to have to change their accounting method, and it's all just this vague speculation. Like, regulators could nudge SoFi to change but it's absolutely nonsense. Like, there's no indication regulators are going to do that. Noto basically came out and said as much as he could that they're not going to change their accounting method, and that they're going to continue to do business in the same manner they have. Um, just because they didn't sell any loans in the first quarter, perhaps it was not a favorable environment to sell those loans, and perhaps they're making more money this last quarter holding the loans on their books because they're collecting so much damn interest. And the money they're making holding it for a couple of quarters in this high interest rate environment, then they can go on and sell the loans in, Q3 or Q4. SoFi gives personal loans for like 2 to 7 year durations. So they could sell the loans near the end of their life and realize profit and still maintain their same accounting system. They just have to sell the loans before they mature, and they don't have to sell every single loan before they mature. They can sell a portion. So, the rationale to cut from $8 to $2.50 is very thin. They may need a capital raise, and they may have to change their accounting method if regulators force them to do so. And there's just no indication regulators are going to do that. And furthermore, the comparison to Lending Club, they're like, well, Lending Club's average borrower has a 718 FICO, which is almost the same as SoFi's 750 average. And if you know credit, 718 and 749 are not almost the same. That is a pretty significant difference, getting from, decent green credit to like a premium level credit, which is above 750. Also, SoFi's borrowers have higher incomes than Lending Club. So SoFi has the type of borrowers you're not going to need to set aside 7%. They're not going to default at that rate. These are people with good careers, good jobs, good homes. They need their credit score to operate and maintain their lifestyle. And they're absolutely not going to destroy their credit over a personal loan. They're like, well, it's an unsecured loan, but it is secured by these borrowers' credit, reputation, lifestyle. And right now, SoFi's loans have not defaulted. They're holding them on the books. There is not an indication that they're going to default at the rates of some of these other banks. And it was just interesting to note on Yahoo Finance. They did a little video on SoFi. Let's just go over. They don't even know who this David Chiaverini is, and they just had him on. And they're like, doesn't this guy cover regional banks? We just had this guy on. They can't pronounce his name. They're like, he covers SoFi? Like, just take a listen.
Today, this has been interesting to track this morning. It's down 9%. This is after Wedbush downgraded the stock from neutral to underperform, slashed their price target from $5 to $2.50, saying SoFi's fair value accounting may present headwinds here. They also noted that there were no loan sales in 1Q, the first quarter, raising questions given that SoFi designates its loans as held for sale. And then they also mentioned that an equity capital raise is apparently being contemplated here. That would lead to a dilution of the share value as well.
Yeah, this is a really interesting look at, and wonky look, let's be honest, at SoFi's accounting. But if you are lending out money and then you sell that loan book, you get a value in the market. It's valued in the market. You know how much it's worth. If you're not selling that loan book, then you're just guessing internally at what that loan book is worth. Mm-hmm. And that is what this note is kind of focusing on. And interesting here, the analyst behind this, I want to mention, who's doing this underperform downgrade, is David Chiaverini, who we spoke to about regional banks. Mm-hmm. So he's been tracking the whole regional bank crisis really closely. And it's interesting that he's now turning his attention to SoFi. To be frank, I didn't even know he covered SoFi, right? Because it's usually covered under people who look at fintech. So it's interesting that he's the regional bank guy, and he is looking at this issue of how these loan books are valued. It reminds me, I have to say, of the so-called held to maturity,
Yeah.
right? Or hopefully held to maturity, unrealized losses. So in other words, we're still talking about the idea of unrealized losses or unrealized valuation. How do you value something internally? So this is kind of I'm not drawing direct parallels, but I'm just, my brain is just thinking along those lines.
Maybe.
So so they just had this guy on their show. They can't pronounce his name. And they're very confused that he covers SoFi when he's his specialty is regional banks, because SoFi's business is not anything like one of these traditional regional banks that got in trouble, essentially because they bought a ton of like 10-year government bonds at very low interest rates. And now, once interest rates went through the roof, they're locked into these low interest rate bonds, and they have to write down the value because the value of those bonds just plummeted, which, they just made very, very poor business decisions that SoFi didn't make. So SoFi doesn't have that kind of exposure. You've already seen them come out and talk about, what kind of exposure they have in terms of and regional banks deposits are fleeing regional banks. Q1, of course, Mr. Chiaverini doesn't address the fact that SoFi added $2.7 billion in deposits. They're growing direct deposit. They have very, very strong capital reserves in terms of their current accounting, which is, again, audited, accepted. Just because they didn't sell loans in one quarter, basically, the analyst is trying to say that they're going to have to change their entire business model to reflect that they're going to hold all their loans to maturity from 2 to 7 years because they didn't sell any for one quarter. Perhaps the demand for the loans is low and they can't get a good price this quarter. And once the Fed stops raising rates and we stabilize and we see, are we going to go into a recession? What kind of recession is it going to be? How bad is it going to be? You still have to recognize, I think, that the quality of these unsecured personal loans is going to be the highest quality borrower in the industry. The credit score on average is over 30 points more than Lending Club. The income on average is $160,000 per year for the borrower. And again, these are not the kind of people that lose their jobs and can't find another one in an economic downturn. These are people that are highly qualified, highly sought after, and, are basically going to be the best, the most, resilient in terms of a recession, in terms of unemployment creeping up just a little bit. These people are not losing their jobs, and these people are not going to stop paying their bills. I believe these criticisms, these two downgrades are, clearly, very, very suspicious. Are they coordinated in terms of being illegal? I have no evidence of that. I can't say, definitively. I'm just giving you my opinion. When I look at this analyst, when I look at his reputation, when I look at his returns, and then I look at another analyst like Andrew Jeffrey from Truist, who, again, they do have an interest in SoFi. So I'm not saying they're completely disinterested, but if you look at his back-tested results, he's a solid 5-star, 4.89 out of 5, number 181 out of 8,300 analysts. He's one of the top analysts in the country. He just initiated SoFi with a buy of $8. And these results don't come, the 5 stars don't come from his firm, like owning SoFi or buying SoFi. These come from looking at his back-tested results. When he makes a call, does the stock make money when he says it's going to make money? That's what this is doing. His success rate is 64%. Look at him versus Chiaverini, one of the worst analysts in the country. So I don't know. This stock is again being heavily shorted. If you take a look at the short overview, there is a slight reduction in the last 7 days. Again, I don't think that's counting today, and I don't think that's counting Friday, and I don't think that's reliable. We have another 4 million shares borrowed today and less than 2 million returns. So the shorts have dug in another 2 million shares. We're Sitting now, the stock is back up a little bit, about $4.60, minus 8%, or 41 cents on the day. Volume is extremely heavy. The first 2 hours of trading, it's about 8:30, by the way, on May 15th. 8:30 a.m. Pacific time, 11:30 out in NYC. Hope it's a great day wherever you are, by the way. I'm waiting for Stock Karen to come back so she can berate me about the condition her kids left the minivan in. But in any case, guys, I just wanted to address this downgrade and again the plummeting in SoFi stock, re-short attack. Um, I think even the financial press, other analysts, probably SoFi themselves, is just a bit confused by this downgrade because they're talking about a capital raise. If you go ahead and take a look at the article that claims against, oh yes, this is now, yeah, here we have these law firm announcements coming out. Why SoFi shares are falling today. This is basically at the crux of the argument is SoFi's treatment as accounting into loans, heavy into personal loans. The approach has been to designate the loans as held for sale, which they still are, hold on the balance sheet 6 to 9 months. But in the first quarter, SoFi did not mark down the fair value of loans held for sale, despite the fact that credit has begun to normalize. The company lends to high-quality borrower, but there still should be some losses. Wedbush believes that SoFi's capital levels may be overstated. Using fair value accounting, if SoFi held the loans for investment, set aside capital, their book value would drop by nearly 60%, apples to apples basis. Listen to this, while Wedbush does not anticipate that SoFi will change its accounting methodology or the fair value of its personal loan portfolio in the near term, it argues that regulators could give the company a nudge, especially what has happened in the banking sector recently. So what it happens in my mind here with these types of guys is they're trying to create a stink on SoFi from these regional banks that made horrible decisions when SoFi does not actually have any exposure to those risks or very little. And then it's just basically taking some contagion argument that says, oh, regional banks have been in trouble, under pressure, therefore we're going to downgrade SoFi from $8 to $2.50 because even though regulators are not going to make them change their accounting method in the near term, even though they have no plan to change the accounting method in the near term, even though they're making cash, they're cash flow positive, even though they're telling us and they're showing us with numbers that they're going to be GAAP profitable in Q4, we just think that there are all these potential problems that could potentially be a problem in the long term, and it's like none of this makes any sense. None of this makes any sense for the magnitude of the downgrade. And listen to this: what the line they point to for the capital raise argument. Furthermore, Wedbush pointed out a line in SoFi's recent regulatory filing that says, if our current net losses continue for the foreseeable future and we are not able to achieve GAAP net income profitability in 2023 as currently expected, but if that doesn't happen, like if something changes and things do not go as expected, okay, we may raise additional capital in the form of equity or debt, which may not be at favorable terms when compared to previous financing transactions. These are the generic boilerplate legalese warnings in the ER that says if things do not go as we expect, which we now expect to be GAAP profitable in Q4, but if that doesn't happen and we continue to make net losses over and over for the foreseeable future into 2024, is how I read this, we may need to raise additional capital in the form of equity or debt. And of course, in a high interest rate, tight credit environment, that's not going to be at favorable terms. But this is just a bunch of absolute BS. Stock Karen even wouldn't accept these arguments, and she wants to speak with your manager. There is nothing to indicate they're not going to get profitable. Their loss it went from Q1 2022 over $100 million net loss down to $30 million 1 year later. So just look at the trajectory, look at the numbers, look at the deposit growth, look at the profit from these loans. That's why they're holding the loans. It's the profit. It's not an accident. Like Okay, so SoFi versus Lending Club, personal loans, how they compare. This is on NerdWallet. SoFi, Lending Club, 4.5-star rating. SoFi with a 5-star rating. Loan term 2 to 7 for SoFi, 3 to 5 for Lending Club. Lending Club 1,000 to 40,000, and SoFi 5,000 to 100,000. This tells the tale. Like, the SoFi is making serious loans to serious people with serious financial credibility. Lending Club's making loans as small as $1,000. This is just not apples to apples at all. NerdWallet says SoFi offers fixed rate loans, very competitive annual percentage rates, and auto pay discount of 0.25%. SoFi personal loans carry no origination fees, prepayment penalties, late fees, or overdraft fees. SoFi loans work best for debt consolidation and funding large one-time expenses such as home improvements. The lender offers high borrowing amounts, low rates, and no fees, but you'll need good credit and strong income to qualify. So this is why they're giving the loans to people with the very best credit and the very best income. And I would just argue that their loans are premium. Their loans are still going to have demand in the marketplace, and they're not selling those loans off because they're making so much money collecting the interest themselves. I believe that these two downgrades from Wedbush, David Chiaverini, who is a horrible analyst objectively, who has very, very little credibility. I don't believe that these sort of known risks and generic legalese in the earnings report can justify him doing two downgrades from $8 to $2.50 based on the last earnings report. It simply strains, it strains logic, it strains credibility, and the fact there's this massive short attack in concert with that ER and these downgrades just is extremely suspicious. I hope the authorities start to investigate these people. What is Wedbush's actual position? They'll say, we don't have any position. We're totally disinterested. I don't believe that for a minute. I believe that the financial media works with the analysts to amplify the message that they want and create the narrative that they want for market makers to pick the pockets of retail investors over and over. And again, SoFi is a retail favorite, the cult-like following. To me, the following for investors is the fact that this company is showing amazing growth as a bank, top line growth, and they're continuing to grow their top line, their deposits, and march toward profitability, continue to increase EBITDA and their cash flows, and they continue to make good margins. And the bank and the business, when student loans come back, when rates come down and mortgage originations pick back up, SoFi is going to be spinning off free cash in 2024 and only more and more as years go by. These risks that they're going to have to completely change their accounting methodology and business model because they didn't sell off any loans for one quarter is absolute hogwash and absolute nonsense. In my opinion, the analyst who did these downgrades is clearly coordinating this with short sellers, maybe not actively. Maybe he just simply decided the stock was worth $8 2 weeks ago and it's worth $2.50 today based on vague rationale and sort of these things he already knew. He already knew that when he had a buy rating of $8, he already knew, that there were, that they might need to raise additional capital if they couldn't reach profit. And he already knew that if they're never sell off the loans and hold them to maturity, just the notion that they didn't sell them in Q1, so that means they're going to, hold them to maturity from now on, is the company's not saying that. The regulators aren't saying that. They might do this, they might do that. But evidence indicates the things they might happen are not going to happen. So it's just, it's FUD. It's pure FUD, and it's really disgraceful in my opinion. But, I think Stock Karen would approve of this analyst. That's just the kind of, I might have to call this guy Stock Karen, because while I have no evidence that the guy is actively coordinating these downgrades, I just think there can be a sentiment, a narrative that these people sort of get caught up in, where they say, oh my God, we're line, let's downgrade. And then the stock starts to go down, and the analysts, basically the tail wagging the dog. Like, the guy's not actually analyzing the stock and making rational decisions for his price target. He's just looking at which way the wind is blowing. He's like, oh my God, shorts are attacking, and insiders are selling, which again isn't true. Insiders are not dumping. Institutions are not fleeing. I would guess some institutions are going to come into the stock at this level with gap net profitability on the horizon. But as I've always said, SoFi needs to make gap net profit to get institutional investors into the stock, put pressure on the shorts, and get the stock price back up where I think it should be, based upon the growth, based upon the execution, based upon the fact that just a few years ago, SoFi was primarily a student loan company. And when that business was completely decimated by COVID and the government's, student loan deferments, that they rebuilt an entirely new business in just a couple of years that is about to make money. And it has frankly been extraordinary. And Noto, Point, management, I tip the cap and I salute you folks, because you're doing a hell of a job. I hope Noto comes out with another buy. God, he can only buy so much stock. But again, this downgrade, I think, was just absolutely designed to kill the stock and help the shorts. And that's my opinion, and I'm entitled to it. I don't have any evidence that Mr. David Chiaverini works for the shorts, but you can look at the timing and the circumstantial evidence, and you can make your own decisions. But I hope investigators and authorities take a look at these things and just see if they make any sense, and just investigate if there's some coordination. I think if you start to turn over these rocks, you'll find a lot that stinks. So SoFi, again, under short attack, based on this one downgrade from Wedbush. Again, if you take a look at the stock itself, on an actual reliable, credible source, you'll see the stock has 9 buys, 6 holds, 0 sells. Of course, it will have 1 sell as that updates. Insiders last 3 months have sold 1 million shares, bought 2 million shares, and insider momentum is into the green. If you take a look at the SoFi stock, rated a moderate buy, 9 buys, 4 holds, 0 sells, average rating $7.65, representing a 66.49% upside from here. Still have the low at $5 because David Chiaverini, of course, downgraded again. He was at $8 just before earnings, downgraded to $5 after earnings to neutral, and downgraded to $2.50 with no new information. What a genius, guys. This is the kind of guy who can, digest the ER, use his expertise, downgrade from 8 to 5 to a hold, and then without any new information, he can downgrade again, cut his target in half based on vague, speculative, nonsense arguments. Guys, I appreciate you tuning in. I apologize for the long, extended rant, but, obviously, as a very bullish SoFi investor who has a large position in the company, I was buying again this morning at the very lows when the stock was down 11%. And I will continue to buy these dips until the company actually starts to underperform, their loans actually start to go bad, actual numbers and ERs indicate they won't be able to make a net profit within the next couple of quarters. I'm not seeing it. I base my investments on the real world things that are actually happening, not sort of these vague, speculative, sort of generic boilerplate statements in the ER. Oh, this might happen, that might happen. Listen, Chicken Little, the sky might fall, but it's not. SoFi is doing very good. The ER was very, very strong given the economic conditions, and I expect a Supreme Court decision. I expect student loans to come back either in Q3 or Q4 of this year, with or without loan forgiveness, and I expect SoFi to make that net gap profit in Q4. And I expect management to continue to execute as they have been doing for the last, couple of years. Guys, thanks for watching. My name's DannyDealz. For Hurricane Lopez, this has been Un Poco Mas, the show where we try to give you just a little bit more. Thanks for tuning in. It is May 5th, excuse me, May 15th, 2023. Let me give you a Toper time check. It's 8:50 a.m. Pacific Standard Time, 10 minutes to the top of the hour. It's a Toper time check. We appreciate you watching in Pocomoss. Also on behalf of Stock Karen, thanks for tuning in. We will rant at you with a bunch of incoherent nonsense again very, very soon. You can count on that.